Why do stock markets suddenly crash? It's a question that has puzzled investors for decades. Markets are supposed to be predictable, right? So why do they sometimes just fall apart like a house of cards? Let's unravel this mystery together. Imagine you're playing a game where hundreds of players are each holding a card high up in the air. The goal is to keep these cards aloft by supporting them with your own hands. But what happens if someone trips and drops their card? Suddenly, all the other cards start to wobble and eventually fall down too. That's kind of how stock market crashes work. It starts with one big player selling off assets, which makes everyone else nervous. Then, it's a chain reaction. Investors rush to sell before they lose more money, just like in our card game. The whole market can collapse quickly because everyone is trying to move their cards at the same time. And here's the surprising part. Crashes aren't always about bad news or economic downturns. Sometimes, it's as simple as a few big players deciding to exit the market suddenly. It's like if all the card holders decided they didn't want to play anymore and just put their cards down. So why do crashes happen? Because of human behavior, fear, uncertainty, and the collective action of many people making decisions at once. But remember, not every sudden drop means a disaster is coming. Sometimes it's just people deciding to take their cards off the table. So, why does the stock market crash? Well, let's dive into the heart of it by understanding something called an order book. Think of an order book like a giant list. On one side are buyers who want to buy stocks, and on the other are sellers who want to sell them. Imagine you're at a busy farmer's market. On one side, there's a line of people holding signs that say, "I'll pay $10 for apples," while on the other side, another line is people saying, "I have apples for $8. The order book works similarly, but instead of apples and dollars, we're dealing with stocks and prices. And here's the surprising part. Prices can change quickly. When the market is stable, these buyers and sellers find each other in a sweet spot where they agree on a price. But when something unexpected happens, like a big company revealing bad news or geopolitical tensions flaring up, those prices can shift really fast. For example, let's say there's suddenly a rumor that a major tech company might have to cut jobs, and all of a sudden, sellers start piling in their orders because they want to get out. Without enough buyers at the new lower price, the market starts to crash as these sellers overwhelm the order book with their sell orders. The order book is like a seesaw. When one side gets too heavy, it can tip and cause prices to plummet. And once that happens, it's not just about those initial big sellers. Everyone who's trying to get out now finds themselves in trouble because they're fighting against the new market conditions. So, when you hear about a stock market crash, remember, it often starts with an imbalance in the order book where too many people are selling at once. Markets don't crash overnight. They usually build up these imbalances over time until something triggers them to tip. And here's the surprising part. Small changes can lead to big effects. Think about it like a butterfly flapping its wings in Brazil, causing a tornado in Texas. This phenomenon is known as the butterfly effect, and it applies to the stock market too. Let's take a simple example. Imagine you're at a coffee shop, and everyone there decides to drink their coffee one sip slower than usual. Before you know it, the barista has a backup of cups, and soon enough, the whole operation grinds to a halt. That's kind of like what happens in the market. In the stock market, small changes can ripple through the order book. Basically, the big list where buyers and sellers make their bids and offers. For instance, if one large investor sells a chunk of stocks, it might trigger other investors to sell too, because they're concerned about the value dropping. This is like the first butterfly flapping its wings. And here's the part most people don't know. These small changes can compound quickly. It's as if those ripples in the coffee shop start affecting more and more tables. Maybe some investors see a news article that makes them nervous, or maybe they just feel uncertain about the economy. All these little factors interact with each other, making it hard to predict exactly when the market will crash. So why do crashes happen? It's not because of one giant event, like an asteroid striking Earth, or even the butterfly in Brazil. Instead, it's the combination of many small events coming together, like a chain reaction. The market is always sensitive to these changes, and sometimes, just like the coffee shop, everything can grind to a halt. Understanding this helps us see why markets aren't immune to sudden drops. They're not some solid fortress with a clear cause. Instead, they're a delicate dance of many small factors. Imagine you're at a big outdoor market where everyone is buying and selling fruits. The market is bustling, with vendors hawking their best apples, bananas, and oranges. Now, picture something unexpected happens. Someone whispers that the apples might be contaminated. Suddenly, fear takes hold, and people start rushing to sell their apples as quickly as possible. The price of apples plummets because everyone wants out. This is what happens in a stock market crash driven by fear. When investors hear bad news, like an economic recession or a company scandal, they become scared and rush to sell their stocks. They want to get rid of them before the value drops any further. This massive selling leads to a sudden drop in prices because there are far more sellers than buyers. And here's the surprising part. It doesn't even matter if the news is actually that bad. Sometimes, the fear alone can cause a crash. People lose their confidence and start panicking, leading to a chain reaction where everyone tries to sell at once. It's like a game of musical chairs. Once the music stops, goodbye market. Those who haven't found a seat, haven't sold, are left wanting. But let's not forget that crashes aren't just about fear. Greed also plays a big role. When things seem to be going well, investors get overly confident and start buying more than they should. They believe the good times will never end. But when reality hits, like it did after the tech bubble burst in 2000, everyone realizes their mistakes. So, while fear can create a quick sell-off, greed often sets up the conditions that make crashes possible. Both emotions, fear and greed, are powerful forces in the market, dictating its movements whether they're rational or not. And here's the surprising part. Leverage is like having superpowers in the stock market, but with a heavy downside. When you use leverage, it can boost your potential gains, but it also magnifies your losses. Imagine you have a seesaw at a playground. If you jump on one end, it goes up high, and if someone else jumps off, that end drops suddenly. Now, in the stock market, when people use leverage, they're essentially jumping on both ends of that seesaw. They think they can make big money quickly, but the moment everyone starts trying to get out at once, like a stampede, the whole system can become unbalanced, and the market crashes. Let's break it down. Say you borrowed $10,000 from your broker to buy stocks, making your total investment $20,000. If those stocks go up 5%, you make $1,000. But if they fall by just 5%, you lose the same $1,000 and more because of the borrowed money. In a crash scenario, everyone is trying to sell fast. The order book fills with sell orders, and buyers are few. Prices plummet quickly, triggering more sell orders. It's like a domino effect. Each falling stock price triggers more panic selling. This sudden imbalance on everyone's balance sheets makes the market unstable, and it crashes. So remember, leverage can be dangerous when used carelessly. It's like having a powerful magnet that attracts not only your gains but also potential losses. So why do stocks crash? Not because of any single event, but due to collective fear, systemic risks, and the complex interplay between buyers and sellers. Understanding this truth can help you navigate the market better. Imagine you're at an airport crowded with passengers. In the terminal, everyone is going about their business, checking in for flights, picking up luggage, or simply waiting. Suddenly, a plane has a minor issue on takeoff, and the announcement comes through. There might be a delay. At first, only a few passengers react. Maybe they check their phone or chat with friends. But as the news spreads, more people get nervous. Soon, everyone is anxious, and the whole atmosphere shifts. In the stock market, it's not much different. A crash isn't caused by one plane going down, or in finance terms, a single company failing. Instead, it's like the airport getting hit with a storm that makes everyone worried. What if all my flights are delayed? The collective fear spreads, and people start to act. They rush to leave just in case. And here's the surprising part. Not everyone is leaving their plane on time. Some passengers stay calm because they have backups or don't find the delay too bad. Others get too worried and decide to hop on board a different flight immediately. This mass exodus from the terminal causes chaos. Some lines are backed up, others empty. In the financial world, this collective fear is like a big sell-off. When investors start selling their shares quickly, like passengers rushing out, it can cause prices to plummet. But why does everyone get so worried? Because systemic risks lurk in the shadows. Think of these as hidden storm clouds hanging over our airport. They could be anything: an economic downturn, geopolitical tensions, or a major company announcement that signals trouble. When one of these storms hits, the market starts to feel the pressure and people get scared. And here's another surprising twist. Leverage plays a big role in making crashes worse. Imagine passengers with bags twice their size. These are financial terms called high-risk or leveraged investments. They might be okay when everything is fine, but when panic strikes, they're the first to fall because of the weight they carry. So how do we navigate this? By understanding that crashes aren't about one plane crashing, but about a storm hitting the terminal. You can manage your risk by diversifying your portfolio, like checking multiple flights, staying informed on systemic risks, and being prepared for market downturns.